Good morning. My name is Miguel Gonzalez, and I'm a retirement specialist with over 20 years of experience helping clients in retirement income planning, overseeing investment of funds, and designing retirement plans. Let's talk about estate taxes and overall estate planning. You may be surprised to learn that there are several ways you could end up paying unnecessary taxes after your death. Strictly speaking, you won't be the one paying, but your estate will, and that could mean your heirs won't receive the amounts you intend. Like most people, you probably would like to pay the taxes you owe and nothing more. Decisions, but thinking ahead, the time to plan is now. And because the tax code is so complex, our first suggestion is that you seek out qualified advice to make decisions that are in the best interest of you and your family. Is it that really complicated? In short, yes. That's because there are a variety of asset types, each of which may be taxed differently. You may wish to pass your assets to a variety of heirs, each of whom may be taxed differently. Decisions you make now and your heirs make later have an impact, and there are at least two overarching tax laws that come into play. If you're like most people, your primary residence and your qualified retirement plan are the two largest assets. Some people also have an investment portfolio, real estate, collectibles, or other valuables. All of these are individual pieces of the puzzle. It's important to seek advice from someone who understands the complete picture and can help you make decisions based on that. Otherwise, your estate may be divided differently than you intend, and with a larger than necessary tax burden on your estate, which means your heirs stand to inherit less than you expected. When you discuss your estate planning goals with an expert, the big picture is important. Accounts with beneficiary designations and those without must be coordinated to ensure your assets are distributed as you wish. For example, if you want to distribute 25% of your total estate to each of your 4 children, look at the big picture. You could divide all of your assets equally among the 4, or you could pass one asset type that is valued at 25% of your total assets to each of them. But that balance could shift as one asset type increases in value as compared to the other. So allowing an expert to help you is time and money well spent. Some of your assets will be valued as of the date of death for future tax purposes. For example, real estate, collections, collectibles, and closely held businesses, among others, can receive a step up in value to your date of death. This is important so your heirs won't face capital gains taxes based on a gain they did not receive. If you bought your home in 1985 for $65,000, for example, and sold it in January 1st, 2019 for $650,000, your capital gain would be $585,000, which could mean a substantial tax bill. But if you died in January 2019 and passed your home to the children, the step-up value means they start with a tax basis of $650 and only pay capital gains taxes on the increase from that point. Assets in a qualified retirement plan, such as a 401k, 403b, or individual retirement account IRA, are taxed uniquely as compared to your other assets. If you die before receiving all of your money in these qualified plans, there are stringent rules that must be followed to maintain their tax qualified status. Tax consequences may differ depending upon who eventually receives these accounts. For example, if your spouse inherits your IRA, it becomes his or hers. They will need to follow the rules such as taking annual required minimum distribution once they reach age 72 as mandated by current legislation. If your children inherit the account though, the rules are different. It's important to understand what the options are and how each will impact your heirs. In general, the person who takes the distribution from a qualified plan will be responsible for the taxes. If your IRA goes to your children, who takes out a lump sum in the same tax year in which he or she earns a high salary, the tax burden could be significant. As you go through your estate tax planning session, you'll need to consider at least 2 kinds of taxes: estate taxes and income taxes. Each type is complex, and how your estate is impacted will depend on the decisions you make today and those your heirs make after you die. An expert can help you sort it out, preserving your estate to the fullest extent possible. Housekeeping note: I'm going to give everyone some homework to do. By simply making sure your beneficiary designations are up to date, you can help your money and other assets get where you want them to go. Anytime there is a major change in your life, birth, death, marriage, divorce, etc., consider it a signal to update the beneficiaries on your retirement accounts, life insurance, bank accounts, annuities, investment accounts. Think about your other assets too, your cars, boats, valuables, sentimental items, and record those decisions in your will. By making sure you properly name beneficiaries, you can remove a needless and unpleasant surprise that sometimes faces their heirs of someone who has died. Once again, this is Miguel Gonzalez with Cortburg Retirement Advisors. Please take a moment to click the like icon, and don't forget to subscribe to my YouTube channel to receive our weekly video podcast every Monday morning. Thank you for watching, and I will see you all next week.